Hi, welcome to the video. Today, we're going to discuss a very important topic. So we're going to be seeing what is included in Warren Buffett's investment toolbox. So we're going to basically analyze the ultimate checklist for investing success. Okay. So in today's video, we're deep diving into the mind of arguably the greatest investor of all time, Warren Buffett. So what if you could peek inside Warren Buffett's brain and understand exactly how he selects winning stocks decade after decade? Okay, that's exactly what we're offering today. A comprehensive breakdown of Buffett's investment checklist that has helped him build a fortune worth over 100 billion. Okay, so whether you're just starting your investment journey or looking to refine your strategy, this video will equip you with the same principles Buffett uses to evaluate businesses. Okay, so we'll cover everything from understanding your circle of competence to calculating owner earnings and determine a stock's intrinsic value. So the beauty of Buffett's approach is that it's straightforward in concept, but incredibly powerful in application. As the Oracle of Omaha himself has said, what we do is simple, but not necessarily easy. By the end of this video, you'll understand each element of his methodology and have practical ways to apply these timeless principles to your portfolio. Okay, so stay with me, and I promise you'll walk away with a clearer investment strategy that can potentially transform your financial future. So this is the checklist used by the world's most successful investor. And today it becomes part of your wealth building toolbox. So what if I told you that the secret of Warren Buffett's investment success isn't some complex algorithm or insider knowledge, but rather a straightforward checklist that anyone can learn? Warren Buffett, who is the chairman of Berkshire Hathaway and one of the wealthiest individuals on the planet, has grown his company share book value by an astonishing average of 20% annually since 1965. So to put that in perspective, $10,000 invested in Warren Buffett's company in 1965 would be worth $300 million today. So the truly remarkable thing is that he's done this using principle that he opens his shares with anyone willing to listen. There are numerous videos around and interviews where he explains his principles. And as Warren Buffett himself has explained at the shareholder meeting, the criteria for selecting a stock is really the criteria for looking at a business. So we are looking for a business that we can understand. And when we find that business, we try to figure out whether the economics of it means that earning power over the next 10 to 15 years is likely to be good and getting better, or poor and getting worse. So what we do is simple, but not necessarily easy, as I mentioned before. The checklist that is going through our mind is not very complicated though. So today we're going to break down that checklist into actionable steps that you can implement in your own investment strategy, regardless of your portfolio size. Okay. Perfect. So the origin of Buffett's investment philosophy, okay, where does it come from? Before we deep dive into the specific checklist, it is important to understand the foundation of Warren Buffett's approach, which was shaped by two influential mentors. The first mentor he had was Benjamin Graham, who is known as the father of value investing and the author of The Intelligent Investor. Graham taught Buffett the concept of margin of safety. So the principle involves buying a stock significantly below the intrinsic value, viewing market fluctuations as opportunities rather than threats, focusing on the underlying business fundamentals rather than the daily price movements, and treating the market as a voting machine in the short term, but a weighing machine in a long term. These are fundamental principles of a value investor, principles which Warren Buffett always follows. Another very big influence, and one of the influential mentors to Warren Buffett was Philip Fisher, who's the author of Common Stocks and Uncommon Profits. Fisher showed Buffett the value of identifying quality growth companies with strong competitive advantages, in concentrating investments in your best ideas rather than over diversifying. And this obviously has to be done if you know what you're doing. If you don't know what you're doing, then obviously you have to diversify your portfolio in order to avoid extra risks. But if you know what you're doing, as Buffett, over diversifying obviously can reduce your returns. Then, holding great businesses for extremely long periods, potentially forever, and looking for capable, honest management teams who allocate capital wisely. So Buffett masterfully combined these approaches to create what he calls value investing with a growth component. He doesn't just look for cheap stocks, but he looks for wonderful businesses at a fair price. This influence, he also says, comes from Charlie Munger, because initially he was more like Benjamin Graham, just looking for cheap stocks and lots of value. But Charlie Munger actually made him understand that it's much better to, as a possibility of growth over the years, that growth component came from Charlie Munger in the sense that he said, okay, yes, let's look for those undervalued stocks with a margin of safety, but look for wonderful businesses, even if they are at a fair price and not extremely undervalued. Okay, so now let's start by breaking down the specific elements of Buffett's investment checklist, which I have organized in 4 main categories. So the business fundamentals, the management quality, the financial performance, and the valuation criteria. So each one of these areas contains specific questions Buffett asks before making any investment decision. And by the end of this video, you'll have a comprehensive framework to evaluate any potential investment opportunity. Remember, it takes many years to be able to have that experience that Warren Buffett and Charlie Munger have gained over the years. So it takes time, but we will give you a comprehensive framework that will allow you to evaluate your investments and start to gain that experience. Like we said, is trying to see from a business point of view, the business fundamentals. Okay, so the business tenets are important. Finding simple, enduring companies. So the first part of the Buffett checklist focuses on the fundamental qualities of the business itself. Buffett starts by asking these critical questions. First of all, is this a simple business that I can understand? Buffett strictly invests within his circle of competence. So businesses he can thoroughly comprehend, and he recommends developing expertise in specific industries rather than trying to understand everything. So he avoids businesses then with complex technologies, constantly changing landscapes on unpredictable futures, because that obviously means you have to keep yourself updated, and it's too complicated to really foresee the future. And so if it's continuously changing environments, that's very difficult. One of Warren Buffett's famous quotes is, "Never invest in a business you cannot understand." A practical application is, start by listing industries where you have personal experience, education, or strong interests. For example, if you work in healthcare, you might better understand pharmaceutical companies or medical device manufacturers. If you are tech savvy, you might grasp certain software businesses more easily. If you are a regular consumer of certain products, you may have valuable insights into those companies. Okay? Think about that. Then, does the company have a consistent operating history? Buffett favors businesses with decades of steady performance. He looks for companies that sell the same essential products or services year after year. He avoids businesses with erratic earnings, frequent strategy shifts, or constant restructuring. Okay, so for example, consider the difference between Coca-Cola and a fashion retailer. Coca-Cola has sold essentially the same product for over 130 years, while a fashion retailer must constantly adapt to changing trends, So making their future performance harder to predict. Some warning signs to watch, for example, are frequent changes in core business strategy, major fluctuations in profit margins, inconsistent revenue growth, regular write-downs or restructuring changes. Then, does the business have favorable long-term prospects? So Buffett seeks business with an economic moat, sustainable competitive advantages. These moats allow the companies to maintain pricing power and profitability over decades. He avoids commodity businesses where price is the only differentiator. So types of economic moats are strong brand identity, Coca-Cola, Apple, Disney, network effects, Visa, MasterCard, and Facebook, high switching costs, Microsoft, Adobe, Intuit, for example, cost advantages, Walmart, Costco, Amazon, regulatory barriers, waste management, utilities, okay? So that's very important for them. Then we have the management tenets, where we identify great stewards, okay? So the second part of Buffett's checklist focus on the quality of company leadership. Even great businesses can be destroyed by poor management. So Buffett carefully evaluates, for example, is the management rational in allocating capital? So great management think like owners, deploying capital only where returns exceed the cost of the capital. They avoid empire building through questionable acquisitions or unnecessary expansions. And they return excess cash to shareholders when attractive investment opportunities are not available. Okay, so the key metrics to watch here are the return on invested capital, the ROIC, ROIC, compared to the company's cost of capital, the history of acquisition success or failure, dividend policy and share repurchase approach of the company, and the debt levels relative to the industry peers. Okay, now he goes on to see is if the management is candid with the shareholders. So Buffett values transparency, honesty, and straightforward communication. So he seeks executives who admit mistakes, explain challenges, and avoid promotional language. He watches how management discusses both success and failure. And signs of candid management are clearly the fact that the management explains very candidly the business performance, both good and bad, and acknowledges mistakes and outlines corrective actions. They set realistic expectations rather than making grand promises, and they use plain language instead of corporate jargon. For example, in his own annual letters, Berkshire Hathaway to the shareholders, he always explains correctly what to do. Okay? So then, Warren Buffett analyzes if the management resists the institutional imperative. What do they mean by that? The institutional imperative is Buffett's term for the tendency of executives to imitate competitors. So he values independent thinkers who make decisions based on business fundamentals, and he avoids where management follows industry fads or pursues growth for its own sake. Some warning signs of the institutional imperative would be acquiring companies just because competitors are making acquisitions, for example, expanding into unrelated businesses to chase growth, making major strategic shift based on Wall Street trends, excessive executive compensation, which is disconnected from performance. Okay. Then there are the financial tenets, where you have to go and analyze and evaluate the performance metrics. So Buffett digs deeper on the focus on return on equity, ROE, and not earnings per share, EPS. So because Buffett views EPS, earnings per share, as a potentially misleading since it can be manipulated, while on the other hand, ROE measures how efficiently a company generates profits from shareholders' equity. So he seeks companies that consistently produce ROE of above 15%, 10 to 50%. I would say that in the checklist, I'll put a 15%, without excessive leverage though. How can you calculate your ROE, which can anyway be seen on many websites and many platforms? But basically, it's the net income divided by shareholder equity, if you want to calculate it. And some important considerations is that ideally, you need to look at ROE over multiple years, okay, at least 5 to 10 years to spot trends. Then compare your ROE to industry peers to identify competitive advantages. Be skeptical of high ROE achieved through excessive debt. And lastly, I would watch out also for one-time events that might temporarily inflate or deflate ROE, but which are not long-term trends. As an example, we could consider that from 2010 to 2020, Apple maintained, for example, an average ROE of above 30%, which reflected its ability to generate extraordinary profits with minimal capital requirements. This efficiently allowed Apple to return hundreds of billions to shareholders through dividends and buybacks while still investing on growth. Okay, the next point then that Buffett goes to analyze and that we would add in our checklist is he goes on to calculate owner earnings instead of relying on accounting profits. So Buffett prefers owner earnings. So the cash a business generally generates for its owners. Owner earnings, which is net income plus depreciation and amortization, minus the maintenance capital expenditures or the CapEx, capital expenditures. So this metric reveals how much cash the business truly produces for shareholders. And why does this matter? So accounting earnings can be manipulated or misleading, and some businesses show high accounting profits but require so much ongoing capital capital investment or capex, that capital expenditures, that little cash is available then for shareholders. That's important. And there are differences between obviously industries and industries. Like the software companies often have high owner earnings since they require minimal capital investments to maintain operations, while railroads or utilities typically have lower owner earnings relative to net income because they require substantial ongoing capital expenditures. So when analyzing companies like Microsoft or Adobe, focus on the free cash flow rather than the accounting earnings, as they have minimal maintenance capital requirements because they are in let's say, the low capex industries. But if you want to compare them, it's better to compare apples with apples, and therefore look at the free cash flow would be a good place to go and focus on for those kind of companies. Then what would you do? You have to seek for high profit margins relative to the competitors. So companies with consistently higher margins than their peers are likely to have competitive advantages. Higher margins provide protection during economic downturns or cost increases. Trend analysis or margins over time reveal whether a company's competitive position is strengthening or weakening. Yeah? So the key metrics here would be gross margin, which indicates the pricing power and production efficiency, operating margins, which shows operational excellence and scale advantages, and the net margin, which reflects the overall profitability after all expenses. A warning sign, obviously, is if you have declining margins over several years, which often then signals increasing competition or a commodization of the company's products, becoming always more a commodity and therefore becoming easily available and with lots of competitors. So compare company margins not just to the broad market, but to direct competitors. And a 15% net margin might be exceptional retail, but on the other hand, might be quite mediocre in software. Okay. The next point in our checklist is to ensure that retained earnings create shareholder value. So what does this mean? When companies keep profits rather than paying dividends, those retained earnings should create at least $1 of market value for each $1 retained. So Buffett tracks the ratio between retained earnings and market value growth. Companies that can't productively deploy retained earnings should return the capital to shareholders. So if you're just sitting with it and not doing nothing with it, it's better to give it to the shareholders in order that then they can use that money in other more productive means. This is what he calls the acid test. So for every dollar a company retains and doesn't pay as dividends, the market value should increase by at least $1 over time. Okay, so compare growth in a book value per share as the percentage of earnings retained over a 5 to 10 year period. Okay. Then Warren goes into the market tenets, which he calls market tenets. And this is for valuing businesses properly. Here we go into the valuation part. So the final part of Buffett's checklist focuses on valuation. That means determining what a business is truly worth and whether its stock offers a sufficient margin of safety. What is the intrinsic value of a business? That's one of the questions you would ask in this point of the checklist. So intrinsic value is the present value of all future cash flows a business will generate. And Buffett uses a discounted cash flow DCF analysis to estimate this value. So he makes a conservative projection based on historical performances and competitive position. What is his approach to the valuation? So he estimates the cash flows, owner earnings, the business will generate over time. Then he applies a discount rate, typically 10%, to account for the time value of money. Then the discount of cash flows, and he arrives to the present value estimate. Okay, so the practical formula for a simple approximation would be to estimate the intrinsic value is current annual owner earnings. So current annual owner earnings, and you multiply that by 8.5 plus 2 by the expected annual growth rate. Okay, but you can find these easily. You can find these values quite easily today. A real life case or let's say application where you can see how this was played out is when Warren Buffett invested in Apple in 2016, and he calculated its intrinsic value based on its consistent cash generation, strong ecosystem, and customer loyalty. While many analysts focus on iPhone sales cycles and all these different kinds of information and news on the headlines, Buffett, on the other hand, looked at the long-term cash flows that Apple's growing services business and loyal customer base was generating. And it turned out to be right. The next point on our checklist, and Warren Buffett's checklist, is he asks himself, can I buy the stock at a significant discount to intrinsic value? So Buffett seeks at least a 25% margin of safety between the purchase price and the intrinsic value. So this margin protects against errors in analysis and unexpected negative developments. If you calculate a company's intrinsic value at $100 per share, you should not and must not pay more than $75 per share, which is basically the 25% discount. So if you're looking at a stock, you like the company, you analyze the company very well, and you decide you want to buy it, go and calculate the intrinsic value. And if the price is discounted with that margin of safety, 25%, go ahead. That's what Warren Buffett does. Okay. So why does the margin of safety matters? It will protect you against over-optimistic assumptions, accounts for the inherent unpredictability of a business, and it creates potential for above average returns if your analysis is actually correct. And lastly, it reduces your permanent capital loss risk, even if your analysis is somewhat flawed. And this is really important, no? Warren Buffett's famous two rules is obviously never lose money, and the second one is never forget rule number one, no? So the loss of capital is really difficult to catch up on the long term, and the margin of safety helps you to try and avoid this. We've covered a lot of ground in this video, so I would now like to summarize the complete checklist, because there was lots of information here, into these 12 crucial elements, and we've seen the 12 questions he asked and the 12 important points of his checklist. The 12 points, again, can be divided into different tenets. So the business tenets, the management tenets, the financial tenets, and the market tenets. In the business tenets, we have the first three. First question is this a simple business I can understand? The second one is, does the company have a consistent operating history? Third, does the business have favorable long-term prospects? Then you go into the management tenets, and after the first three, you have another three. Is management rational in allocating capital? And again, is management candid with shareholders? And does management resist the institutional imperative? Then he goes into the financial tenets. And the financial tenets are four. And those are: focus on return on equity, not just earnings per share. Calculate owner earnings instead of relying on accounting profits. Then seek high profit margins relative to competitors. And last, ensure retained earnings create shareholder value. These are the four financial tenets. And the last two, to reach your 12 points of the checklist, are the market tenets, which is basically, what is the intrinsic value of the business, and can I buy the stock at a significant discount to intrinsic value? So by systematically working through these questions, you dramatically increase your chances of making successful investments. And remember that Buffett's wisdom. So risk comes from not knowing what you're doing. So this checklist helps you ensure you know exactly what you're doing, or at least help you to try and understand more what you're doing. One final aspect of Buffett's approach that deserves emphasis is patience. Buffett is famous for his discipline in waiting for the right opportunity. And he says, and I quote Buffett, "The stock market is a device for transferring money from the impatient to the patient." Okay? Remember that. Patience is fundamental. So, what are the key principles which you can analyze and think through? You don't need to be active to be successful, no? Being active, you can be running the whole day, and at the end of the day say, I didn't accomplish anything, you know? There are those days which you'll be running and running and running, and you get home, you're tired, and then you think and say, what did I do today? And at the end, you accomplish nothing. So you don't need to be active to be successful, because on the other hand, maybe some days where you're really relaxed, concentrated, and you did 2 or 3 things, big things, important things, and you succeeded in doing much more than you would have if you were more active. So sometimes the best action is also no action. So apart from the fact that sometimes you can accomplish more by doing less, it's also the fact that sometimes it's better not to do anything at all, because that action would have maybe actually made you go backwards instead of forwards. Another aspect of being patient is that you have to keep cash reserves ready for exceptional opportunities. So being patient means always having big cash piles aside in liquidity, which is necessary when those occasions happen where you have to act immediately. So the market will eventually crash or have problems, and then those great businesses which were maybe overvalued become automatically undervalued. There are margins of safety, but you do not have that at that point maybe some cash reserves. So be patient and keep those cash reserves. And then also be patient when you're investing in the companies. You're keeping companies for the long term. This is long-term investing. You have to keep that company for 10 years, 15 years, and the market fluctuates up and down. But if the fundamentals of the business and the business you've bought into, the company you've invested in, is a solid company and you've done your homework right, the market will eventually recognize the value of that great business you've invested in. And lastly, time is the friend of wonderful businesses, but the enemy of mediocre ones. So patience is fundamental. Just to give an example, between 1997 and the year 2000, Berkshire Hathaway significantly underperformed the S&P 500 during the dot-com bubble. And critics started calling Buffett obsolete, he had lost it. But when the bubble burst and Berkshire preserved capital while the market crashed, Buffett again demonstrated why he's so successful. No? Sometimes the most profitable decision is avoiding losses by sitting on the sidelines. It's much more difficult to catch up on your losses. Never lose money. Again, the first rule, according to Warren Buffett, is never lose money. The second one is never forget rule number one, because trying to catch up from a 50% loss really takes lots of time. So being sure and patient in your investing decision is very important. How can we now implement Buffett's wisdom in your portfolio? Because now that you understand Buffett's framework, how can you put it in practice? Here are some actionable steps based on your investment experience, because it changes a lot based on your experience and your risk tolerance and things like that. So for beginner investors, I would say that you could start by defining your personal circle of competence, industries and businesses you truly understand. Practice calculating key metrics so that you can understand those metrics like the ROE, owner earnings, profit margins on companies that you're familiar with. Consider index funds for most of your portfolio, while in the meantime, you develop your analytical skills, investing maybe in single stocks. I would also invest like 5% of your portfolio. Just a small amount so that you don't get scared, and you can, but it helps you to start getting used to the market fluctuations, and you'll learn a lot, but at least you're not risking your portfolio. Then read annual reports of companies you use and love so that you can start building your analysis muscle, okay? Then for intermediate investors, I would say start developing a systematic investment journal where you record your analysis of potential investments, create a watch list of 20, 30 companies that meet Buffett's business and management criteria, calculate the intrinsic value estimates for your watch list company, and set yourself some target entry prices. Then allocate a portion of your portfolio to high conviction individual stocks that meet Buffett's criteria. Okay. Then lastly, for advanced investors instead, consider a more concentrated portfolio approach with 10 to 15 high conviction positions. Okay. Adopt a longer holding period. Aim to hold great businesses for years or decades. Okay. Warren Buffett says, if you are not willing to buy a business, a company on the stock exchange, so shares, but of a business, and be comfortable, even in the case that the stock exchange closes for 10 years and you're not able to sell your company, you don't have to buy it in the first time. So you have to be comfortable that once you bought that company, the stock exchange can close for the next 10 years and you're comfortable with it. If you're not comfortable in that scenario, then it means there's something wrong and you should not even buy that company. Develop deeper industry expertise in specific sectors where you have an analytical edge. And then create detailed discounted cash flow models for your investments with various scenarios to test assumptions, okay? And that's it. Before we wrap it up though, remember that investing success does not come from complex formulas or timing the market, but it comes from a disciplined approach to finding basically wonderful businesses at a fair price. And as Buffett says, the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of a given company and above all, the durability of that advantage. Okay. I hope you found this breakdown of Warren Buffett's investment checklist valuable. Okay. Please hit the button below, subscribe to our channel for more wealth building content, and share this video with someone who could benefit from these timeless investment principles. Thank you very much for watching, and I really hope that you found this breakdown of Warren Buffett's investment checklist valuable for you, and I'll see you in the next video. Keep well, everybody. Bye.